Imagine paying an extra $1,000 just because you did not send money to the government on time. This is often a harsh reality for many side hustlers when it comes to quarterly tax payments. These payments are not optional. They are a critical part of the United States tax system for anyone earning income outside of a traditional W-2 employer. If you are self-employed, you become both the employer and the employee. This means you are responsible for paying not only your income tax, but also self-employment taxes. Self-employment tax covers Social Security and Medicare. The Social Security portion is 12.4% on earnings, up to a specific annual limit for 2024. This limit is $168,600. The Medicare portion is 2.9% and has no earnings limit. Combined, that is 15.3% right off the top of your net earnings. This 15.3% applies to 92.35% of your net earnings from self-employment. For instance, if you earn $10,000 net from your side gig, you pay self-employment tax on $9,235 of that income. You must generally pay estimated tax if you expect to owe at least $1,000 in tax for the year from your side hustle. This rule is set by the Internal Revenue Service, known as the IRS. Many people who work a full-time job and have a small side gig do not realize this requirement. They often think their W-2 withholding will cover everything, but that is usually not true, especially as side hustle income grows to $5,000 or even $10,000 annually. The federal government uses this threshold as a basic indicator of significant independent income. Missing this threshold is a common mistake for new entrepreneurs. The tax year is split into 4 payment periods. The first period runs from January 1st to March 31st, with a payment due date of April 15th. The second period is April 1st to May 31st, due June 15th. The third covers June 1st to August 31st, due September 15th. The final period is September 1st to December 31st, with a payment due by January 15th of the next year. If any of these dates fall on a weekend or holiday, the deadline shifts to the next business day. It is easy to miss these dates if you are not organized. Forgetting them can lead to penalties. These payment dates are fixed. They do not change year to year unless a holiday impacts the exact day. Knowing these 4 dates is a fundamental step to proper tax compliance for side income. The penalty for underpaying estimated tax can be substantial. It is essentially an interest charge on the amount you underpaid. For the second quarter of 2024, the interest rate on underpayments is 4% per year, compounded daily. This rate changes periodically set by the IRS. Imagine owing an additional 4% on an unpaid $5,000 tax bill. That adds up fast. This could be an extra $200 just in interest. The IRS forms for estimated taxes are called Form 1040-ES. You can find these on the IRS website. They include worksheets to help you calculate your estimated tax. These worksheets are often 25 pages long and detail income streams. They have line items for business income expenses and deductions. Each page guides you through specific calculations, ensuring you account for every relevant financial detail. It is not just about raw income, it is about your net taxable income. This distinction is crucial. Most side hustlers need to estimate their income and expenses very carefully. This is not always straightforward. When your income varies each month, a good strategy is to set aside a portion of every payment you receive from your side hustle. Many tax advisors suggest setting aside 25 to 35% of your income for taxes. This percentage might be higher or lower depending on your overall income and tax bracket. Keeping good records is paramount. Every dollar earned, every dollar spent related to your side hustle should be tracked. This includes income from platforms like Etsy, Uber, freelance clients, consulting gigs, or selling handmade goods. And expenses like website hosting software subscriptions, home office costs, mileage for business travel, specialized tools, marketing expenses, professional development courses, and even a portion of your utility bills if you have a dedicated home office. You can deduct many legitimate business expenses. This reduces your taxable income and therefore reduces your estimated tax payments. For every $100 in deductible expenses, your taxable income drops by $100. This can save you $20 to $35 in taxes, depending on your marginal tax rate, which could be 12%, 22%, or even higher. There are ways to avoid penalties, even if your income fluctuates. These are called safe harbor rules. One safe harbor rule states that you can avoid a penalty if you pay at least 90% of your current year's tax liability through estimated payments or withholding. Another common safe harbor rule is to pay 100% of your prior year's tax liability. This is often easier for those whose income is somewhat stable. If your adjusted gross income in the prior year was more than $150,000, You need to pay 110% of your prior year's tax liability to meet this safe harbor. Many people use the prior year's tax as a baseline for their first few estimated payments, then adjust later in the year if their income turns out to be much higher or lower. This adjustment is usually done by updating the figures on the Form 1040 ES worksheet for the next payment period. For example, if you estimate a $2,000 tax liability for the year, you would aim to pay $500 each quarter. If your income then doubles, you would need to adjust your subsequent payments upwards significantly to meet the 90% rule. This helps prevent unexpected underpayment penalties. State income taxes are another layer of complexity. Most states that have income tax also require estimated tax payments. The rules and thresholds vary by state. For example, California may have different requirements than New York or Texas, which has no state income tax. It is essential to check your specific state's tax department website for their rules. You might need to file separate estimated tax forms for your state. This means managing not just federal payments, but state ones too. Some states even have local income taxes for specific cities or counties. For instance, Philadelphia has a city wage tax that applies to self-employment income for residents. This adds yet another layer of required payments. Ignoring state or local estimated taxes can lead to state or local penalties, which can also be substantial. Always factor in your geographical location for these calculations. Using tax software or working with a tax professional can simplify this process immensely. Software programs can help you track income and expenses and even calculate your estimated payments for you. They can also remind you of upcoming deadlines. Many side hustlers start their ventures without understanding these tax obligations. They might think they only need to worry about taxes at tax time in April. This misunderstanding can lead to a huge surprise bill. And that surprise can come with significant penalties and interest. A $5,000 tax bill can quickly become $5,500 or more with penalties. Some popular software options include QuickBooks, Self-Employed, TurboTax, Self-Employed, or H&R Block Deluxe. These tools are designed to streamline the record-keeping and estimation process, reducing human error. Some even offer direct payment submission. Planning for quarterly taxes is not just about avoiding penalties. It is also good financial management. It prevents you from having a massive tax bill come April 15th next year. Imagine having to find $8,000 suddenly for taxes. This level of stress is completely avoidable with proper planning. Setting aside money regularly creates a disciplined financial habit. It treats your side hustle like a real business, not just a hobby. Even if your side hustle is small, like earning a few $100s a month, it is still subject to these rules once it crosses the $1,000 estimated tax threshold. Even earning $100 a week could easily push you over the $1,000 annual owed tax limit. This is about being proactive and building financial resilience. The tax system is a pay-as-you-go system. If you are not an employee having taxes withheld from every paycheck, then you need to proactively pay your share throughout the year. The IRS has robust systems in place to identify underpayments. They send out notices explaining the penalties. These notices can be unsettling. It is far better to be proactive and make those payments on time. Penalties are not the only concern. The IRS can place liens on property or levy bank accounts for unaddressed tax debts. This is an extreme measure, but it underscores the seriousness of tax compliance. This ensures the government receives its due share throughout the fiscal year. You can make payments online through IRS Direct Pay, or you can pay by phone using a debit or credit card, though a processing fee may apply, usually around 2%. Or mail a check with your Form 1040 ES voucher. Paying online is usually the easiest and most reliable method. It provides instant confirmation of your payment. Some people even adjust their W-2 withholding from a main job to cover side hustle income. This can be done by submitting a new Form W-4 to their employer. Increasing your withholding by a certain amount each pay period can ensure enough taxes paid through the year. For example, if you estimate you owe $2,000 extra this year, you could ask your employer to withhold an extra $167 per month. This automatically fulfills your quarterly tax obligation without needing to send separate payments. It is a smart move for those with stable side income. For those with highly variable income, adjusting W-4 might be less precise. Tax laws change. Always check the current year's IRS publications and rules. Do not rely solely on what you heard last year. The tax landscape evolves, and so do the rates, limits, and regulations. For 2024, the standard deduction for a single filer is $14,600. For married filing jointly, it is $29,200. Head of household filers get $21,900. These deductions reduce your taxable income. Understanding how they interact with your side hustle income is important. A side hustler might earn $12,000 from their gig, and if they are single with no other income, their standard deduction covers much of it. But if they have a main job earning $60,000, the side hustle income pushes them into a higher tax bracket quickly. Always consider your overall financial picture. A common tax bracket for a single filer earning $50,000 in taxable income, for example, is 22%. Your side hustle income adds on top of that. The gig economy is booming. Millions of people are earning income through various platforms, and self-employment data from the Bureau of Labor Statistics shows a significant rise in contingent and alternative work arrangements. For example, nearly 17 million Americans reported income from the gig economy in 2023. Many of these workers are considered independent contractors. They receive a Form 1099 NEC or Form 1099K instead of a W-2. These forms report non-employee compensation. If you receive a Form 1099K for payments over $20,000 or 200 transactions, or if your state has a lower threshold like $600, it means that income is reported to the IRS. This makes it almost impossible for that income to go unnoticed. The government knows you are earning this money. This is another reason why proactive tax planning for your side hustle is so vital. It prevents future headaches. It secures your financial standing, it ensures you remain compliant with tax law, and it avoids those unnecessary interest charges and penalties. It is simply good business practice. Paying your taxes quarterly for your side hustle is not just a legal obligation, it is a key part of financial responsibility for any independent earner. It is about understanding the system and navigating it effectively. Without those proper payments, the consequences can be financially painful and deeply frustrating. The peace of mind gained from timely payments is worth every effort.